Okay, so as we wrap up the inventory quiz, and you just typed in the chat what two numbers go into inventory turnover, let's talk about inventory turnover. I'm going to go ahead and share a screen. And when you look at inventory turnover, you start by saying, okay, I've got inventory. That's kind of obvious, except the catch is I need average inventory. We'll discuss that more in a minute. But I had two different answers in the chat. One of you said, some of you said sales. Matter of fact, a whole bunch of you said sales. And some of you said cost of goods sold. Now, is our inventory at cost or is it at selling price? When we buy inventory, do we buy it at what we're going to sell it for? Or do we buy it at what we call our cost? Okay, I'm seeing some nods. We buy it at cost. So it's based on cost. If you try to use our inventory and say, okay, I got my selling price, and some of you were putting sales in the numerator and inventory, average inventory in the denominator. I like the average inventory, by the way. You're going to be distorted depending on what you sell for. When we had a car dealership that we created, we paid $20,000 for the car, and if we sold it for 25, that would distort the sale. If we sold it for 30 or 50, that would make the sales even more radical. So the next question is, based on this, we're going to have cost of goods sold. Not sales, but cost of goods sold is going to be part of the formula. Now, which is a bigger number? Go ahead in the chat, type in for me, is cost of goods sold a bigger number normally, or is inventory a bigger number normally? Please go ahead and type in the chat what your thought is about that. Yep, you need cogs, it's fine. Cogs in the wheel. You got it. Yeah. And you get to cheat. You always, what do they type? Okay, I can do that. That's cool. Okay, we're good. All right, excellent. So if you think about it, which is a bigger number? Cost of goods sold keeps going up. But inventory goes up, goes down, goes up, goes down, goes up, goes down, goes up, goes down. And technically, cost of goods sold should and almost always, never say never, I'll always never say never. Don't always say always. Cost of goods sold is almost always higher than inventory. So we put the bigger number in the numerator and we'll put the smaller number in the denominator. So we're going to have our cost of goods sold in the numerator and our average inventory in our denominator. As you recall, whenever we mix a ratio that has an income statement item and a balance sheet item, we've got to take the average. So by taking that average, we're taking the average throughout the year. So we have our cost of goods sold, keeps going up, bigger number. So if I had let's say $12 million in my cost of goods sold and $2 million in my average inventory, I get 6 turns a year. What does that mean? Well, on average, over the year, I sell 100% of my inventory 6 times. I might ask you to say, well, what does that translate that to days for me? Okay, I want to make sure that I'm figuring this out and it makes kind of sense. What days is that? So if I take 365 days, divide by 6 turns, I'm going to come up with basically 6 into 36 is 6, basically 61 days. So that means on average, every 2 months or every 61 days, 100% of my inventory gets sold. Cost of goods sold. That's telling me now, not everything is sold. I've got stuff that's been there for 2 years. I got stuff that comes in and a week later it's sold. But on average, I've got 2 months worth of inventory covered. And we'll talk more later on. Is faster better, slower better? Well, it depends. Typically faster is better, but can it be too fast? Yeah. You talked about having too much cash. Can you have too much cash in business? Actually, you can. You say, well, what do you mean I have too much cash? Well, if I'm making 1% on millions of dollars, and you should be either investing it, because I want a 5 or 10% return when I invest in a company. You're making 1%. Give me the money. I'll go put it somewhere else that's going to make more money, or you spend it or invest it, buy materials, expand facilities, buy another business. There could be a reason you have a lot of cash. You might be holding on to cash for expansion purposes, but I don't want you holding on cash as a matter of habit. Bad idea. So here's our inventory turnover. Why am I sharing this? Because in the next chapter, when we get over to chapter 7, we're going to talk about receivable turnover. And receivable turnover is our receivables at our retail selling price or at our cost, our inventory cost. Well, we can think about that. Our receivables are based on what we sell. So it's our selling price. So if I asked you what goes into account receivable turnover, you're going to come back to me and say, oh, that first part's easy. Accounts receivable. And then you say, oh, yeah, I remember now. It's average. You got me, Scott. Average accounts receivable. And then what's the other number that goes with the ratio? Well, how many times we turn over our receivables? That's going to be based on sales, net sales. I'll ask you the same question. Which is a bigger number? Receivables or sales? And if you were to say, well, sales keep going up, 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 up. Occasionally we get a return. It might dip, but we go up, up, up. And receivable goes up and then we get paid. Down. Sales some more, go up, and we get paid. Down. Up, down, up, down, up, down. So in theory, my bigger number should be net sales divided by average receivables. AR turnover. So unlike earnings per share, return on assets, return on equity, debt to asset ratio, those are the definition. I just told you what those ratios are. Return over average assets, return over average equity. The inventory turnover is a little more confusing because you got to remember, okay, I got inventory and cost of goods sold, receivables turnover, I got sales and receivables, and then I got something called asset turnover. That one is also net sales over average assets. These are not as intuitively obvious, although if you think about them, I expect you to memorize these. I expect you to know them. You're going to use them in finance, and you're going to use them throughout your business career. And so you should be able to have recall of these things come back at you. But I want to go through this with an explanation so that it kind of makes sense in saying, okay, I get it. I kind of understand this stuff. I'm on track. Okay, so that's a wrap on inventory. Any questions on inventory before we continue onward and upward and talk about internal controls, cash, bank recs, and wrap things up there? All right, that being said, let's go back to our, clear that out. See that? You don't need to see that. So I'm going to go ahead and take a look at our PowerPoint. And some of the rules of internal control. We talked about internal control. We talked about Sarbanes-Oxley last time. Anybody remember what section we were talking? Section 404 of Sarbanes-Oxley is report on internal controls. You want to impress your accounting friends? Talk about section 404. They'll appreciate you that much more. But the key here is this: internal controls are important. And why are they? They're even more important now than they were 50 years ago. 50 years ago, when you had a 100 or 120 person company, you had 30 accountants. 25% of your staff was accounting staff, bookkeepers, folks that kept the books of original entry. Nowadays, you can have a 120 person company with a half-time CFO and maybe a bookkeeper or an accountant, or maybe a full-time CFO. 2 people, 1.5 people can handle the job because you've got software that does all this point of sale stuff, does all this tracking, does all this information flow. And yeah, you got some records you got to keep, but it's a lot easier. As a matter of fact, in the good old days, when you had to do a budget, it would take a week and a half to say, okay, let's do a budget for next year. And you have 6 people on it, and they're writing these things down manually and looking out their calculator and saying, oh, let me total this up and add this all together. And then as CEOs and CFOs do, let's go ahead and raise our price by 10% and hire 2 more people. Okay, give me a week. And that's what you do. You go back, you say, okay, I have 2 more people. How much did I make? How much did it take? Okay, let me run into that. Nowadays, you got a spreadsheet. Oh, 2 people. Change that from 40 people to 42. Good, got it. Price increase, okay, that up 10%. Oh, change that to 10% increase. Yeah, instead it was 5%. All right, here's our budget. Matter of minutes, you can do a new budget. So you don't need those 30 plus people on accounting to do all this stuff. It's great, it's powerful. And you can do a lot of what if. And you can do a lot of analysis. And you can do these pivot table things that we talk more about. All right, but with 2 people handling the accounting, there's a much higher percentage or opportunity for fraud, for someone cooking the books, for taking money when they shouldn't. So I'm going to talk about this human fraud triple threat. Okay, we call it the fraud triangle. I'll draw the picture. Opportunity, financial pressure, and rationalization. So let's go ahead and let's do a whiteboard. And let's do that picture. We're going to clear the screen. And we have our, let's draw it here. Okay. So we're going to draw a triangle. Right? And let's go ahead and type in a couple of things on that triangle. So we have opportunity. Well, what's an opportunity? Well, no one's looking, I can take it. Or I'm in charge not only of receiving the goods, but ordering the goods, verifying on a piece of paper that we received the stuff, writing the check, signing the check, and putting it and sending it out in the mail. That's a glorious opportunity. That's a big hole. That's a big gap. Let's talk about financial pressure. I've got kids at school, we got tuition payment. My spouse is looking for a vacation, and this vacation to Charleston isn't going to cut it. She wants a vacation. He wants a vacation. This is the Caribbean. This is over to Russia. This is over to Japan. This is a vacation. Okay, we're going to Europe. All right, this is a 3-week vacation. We're under pressure, and I still got to pay the kids' tuition. So we look at that and we say, okay, so there's an opportunity. There's a financial pressure. And finally, we got something called rationalization. Get the ization out of here. What's the rationalization? I am a salesperson. I just landed a $2 million contract, and all I got was a lousy $20,000 commission. It's $2 million. The company's making over $1 million bucks, and they give me 20 grand. I've been here 15 years. And they haven't given me a raise anyways. Or maybe I'm an hourly employee. I'm over at Costco now making 16 bucks an hour. That's great, except I deserve 25 for what I do. I got to put up with customers all the time. All right, I deserve more than that. And I've been here 5 years. I haven't gotten a raise or 10 cents an hour raise here and 10 cents an hour raise there. That's not worth it. They owe me more. And by the way, the camera in the back office in the back is turned off, or I turned it off. I actually pulled the plug. I pulled the cord. No electricity to it. The camera's not running. Yeah, we got that covered. Okay, back door, alarm's turned off. We're good. Okay, and I need a TV set anyways. So opportunity, rationalization, financial pressure. I'm going to give you a few examples of these kind of things. And it could be, and this is a kind of a rule of thumb. Now, there could be different degrees of all 3 of these elements, but these elements are the common elements that you see in fraud. Has anybody here heard of KOSS Corporation, KOSS? They make headphones, and they make ear. They have they're a Milwaukee company, about $25–30 million in sales. The CFO stole over $20 million in a 5-year period. How did they steal over $20 million? You think that would make a dent? You think the auditors would catch that? They didn't. It was found, it was a Friday afternoon, a call came in from American Express. And the CFO wasn't there. They took Friday afternoons off. But one of the majority owners was there and took the phone call, and American Express said, we got a check for $120,000. Which American Express account do you want us to apply that to? And the sharp guy said, why are we paying American Express $120,000? What did we buy? We got a lot of stuff from American Express. To American Express, did we buy inventory, stock, materials, furniture? I don't know. What do we get? Looked at the bills and said, wait a minute. There's a whole bunch of furniture on here, and a bunch of jewelry, and a bunch of clothes, and a bunch of stuff that I don't think we need clothes for most of our folks here. Did a little digging, and that weekend had local law enforcement and the FBI. And by Monday morning, handcuffs were on the CFO. Happened to have a shopping addiction. Addictions are pretty nasty stuff. You've heard about drug addictions. Probably don't hear about gambling. Probably haven't heard too much about shopping addictions. But they had warehouses full of stuff. The spouse was the head of Children's Hospital. Did pretty well. The CFO did pretty well. Did they need all this other crap? Probably not. But with an addiction like that, $20 million, a lot of money to spend, but had the opportunity. Addictions rationalize the heck out of things. I got an addiction. Okay, I need to do this. I can rationalize. Financial pressure may not have been there in heavy doses, but I don't have $20 million. I really need this stuff. So there's some pressure there. All right. So it is pretty crazy. It's pretty nuts. All right. Now they went through a divorce. They went through other issues. Yeah, there was jail time and other things going on. But that happens. It happens in corporations all the time. But it doesn't just happen in for-profits. I mean, Miller Brewing had the same problem. SAB Miller, South African Brewer Miller. They had collusion between a marketing director and a staff person and a third party, and they were stealing money. Let me give you an example of a nonprofit. Nonprofits, out of the goodness of their heart, they're not going to steal, are they? I'm afraid so. Goodwill. Good organization, serves a lot of people, does a lot of good things. This organization, there was a 24 years employment, the heart and soul of Goodwill. Anybody had a question? They knew the history. They knew the organization. They supported the mission. They were, as I say, the heart and soul. Over $500,000 stealing from the organization. That one was discovered when the auditor fortunately caught it this time, when they saw that a casino had a debit card transaction on their bank account. And the accountant was smart enough to say, what is somebody doing at the casino? Were they at a conference or meeting, or were they whatever it might be? Well, it turns out this person had a gambling addiction. And they only figured out it was $500,000 because the insurance was $500,000. It was actually more than $500,000 that they stole. But they also stole, they have a spouse who was in the trades, was a plumber, and they had some plumbing bills that were processed and paid. They didn't have that much in plumbing bills they needed done, but there was a whole bunch of plumbing bills that got paid that apparently they took it out in cash. And again, that is the person that was the, as I say, heart and soul. And you always wonder when someone doesn't take a vacation for a long time. They can work for 5-6 years, no vacation. Those are the people you really worry about. Not that they're dedicated employees, it's that they're covering up the stuff. If somebody else looked at the books, they'd find it. You want to look at Dixon, Illinois someday, the multi-million-dollar from the small town, Dixon, Illinois. So fraud, I hate to say is rampant, but it is. But if there's opportunity, powerful. Rationale, we all rationalize. Financial pressures, all the time. We're all under pressure. So be aware that it's not as uncommon as you would hope. FIFA, Soccer Federation. Where are the games played? Who's going to get the championship? Olympic Committee. Are there bribes going on in the Olympic Committee? Every 4 years, I don't know who really want to have the Olympics in their home country or their home city, other than it's good publicity, but it's also very expensive and they lose a lot of money. And they have all this stuff, infrastructure when they walk away that never gets used again. So that's a different story. But the whole idea is people want to take advantage. And let's move over. Let's get us on the map. Let's get some tourism going. Let's get people coming through. So be aware, be careful. It's around there. It's rampant. And sometimes it's human error. But sometimes it is fraud. And so human error is careless, misjudged, yes. Okay, so you saw the video last class, right? Right. And there's some of them were traders. So an employee that's trading millions, hundreds of millions of euros or dollars, or nearly $1 billion, it signs the market. Okay. Well, did they do anything illegal or immoral or wrong? And that's the question. Now, a lot of this fraud may not be specifically to put money in your pocket. Some of it is because you're under financial pressure as a company to show better performance. And now you're in a situation where I'm not making any money out of this, but the company and my employees, I'm doing it for the team. I'm doing it, I mean, I'll say culturally, and I'm not trying to stereotype, but Japanese culture is very much of a group culture, as is Chinese culture. And the group think is, yes, we're in this together and we need to succeed together and we're on track. So I want to make you aware that there are a variety of reasons and not always personal gain. It's not just in my pocket, although often it is. Or we talked about the birthday party for $2 million in the Greek islands with Jimmy Buffett as a guest presenter, a guest entertainer for my wife's birthday party. Great, you know, that's a publicly traded company. That's a little bit excessive, probably. I know I wasn't invited to it, so it obviously was excessive. Had I got the plane tickets and gone, no, it would have been fine. But you get the idea. So, but to answer your question, how does it happen? For all kinds of reasons. If egos get in the way, we're supposed to be, we're a high flyer, and we tripped and fell. I don't want to tell you, but keep the secret safe. So, all right, so let's take a look at control, internal control. So let's talk about cash. Cash is kind of key. Cash is the bread and butter. Cash is the king and queen. So we want to make sure cash comes in the door. It's going to the bank quickly if we can. We separate handling cash from the record keeping. So we got people handling cash. We get different people recording it, different people depositing it in the process. And ideally, receipts and disbursements are in the form of checks, not cash, because cash is too liquid, too easy to put in your pocket, too easy to disappear. Let's talk about cash and cash equivalents. I'm going to emphasize credit card payments received by a company are considered cash, not accounts receivable. You say, yeah, but isn't it receivable? You're going to get in a day or two, you're going to get the money? Well, the short answer is yes, you are right. In a day or two, you do get the money. But the pretty well assured, once the credit card company approves it, money is coming in. So whenever we talk about credit card receipts, we'll call that cash. Currency, coin, bank deposits, customer checks, cashier's checks, even though we're depositing a check, it takes a couple days to clear, that's considered cash. And then there's cash equivalents. Highly convertible to cash, easily converted, easily sold, maturity date, next 2-3 days, notes receivable, or anything that might be considered, oh, I've got this cash, I've got Apple stock, I can in 3 minutes sell it, turn it to cash. Okay, so cash and cash equivalents, marketable securities. The goal of cash management, meet cash payments when due is why you have the cash, and you don't want to keep too much cash on hand. You don't make very much money on having cash on hand. As a matter of fact, you become an acquisition target. People want to buy your company because you've got cash and they want cash. They're going to buy your company, get your cash. Okay. Encourage collection of receivables, speed that up. Delay payments, liabilities, slow that down. Keep only necessary assets. Don't buy too much excess. Because that stuff can break, stuff can go bad. It's like too much inventory. Plan your expenditures and invest excess cash. All right. So I'll make an exception here. When I have a plumber do work in my house, terms are net 30. I want to pay in 48 hours. Why? Because I want that plumber to know that, that's Dr. Scott guy. He pays his bills pretty quick. So when I call and I've got a leaky faucet or I've got a flood coming across my living room floor, I want them out pretty quick. Okay, I want them coming quick. I don't want to wait 30 days like my payment terms. So think about it. I have a customer. I had a customer, small customer, but I know when I sent a bill within 48 hours, I'd have payment. My terms were not 30, but they were quick to pay. I had another customer who took advantage of the 30-day terms. I had 2 messages on my desk, one from each of those customers. Who do you think I called first? Well, it depends. Okay, true. Chances are I'm going to call the quick pay. But then again, if I know something's going on, I know somebody's having a problem, and even though they paid 30 days, they got a problem, I'm going to deal with it too. I want to take care of my customers. But you get the idea. So it depends. Sometimes rules are made to be broken, but be aware of what's going on. Over-the-counter cash receipts. Yep, we're going to have separate receipts, disbursements, and processing to go with that. Cash over and short. Usually it's more short than over, by the way. What happens is count the cash register and you should have $500 in the drawer. You only get $495. Somehow $5 disappeared. Now, if it happens every day with the same cashier, you know what the problem is. Probably. Yes. I know a customer comes over every day and messes with it. No, probably they're stealing it. But some days it's $10, some days it's $20, but it's always short. You got a potential problem, potential. So we know who's responsible. There's a cash over and short count. Cash receipts by mail. 2 people are assigned to open mail. That's not just checks. Cashier deposits the cash in bank. The record keeper records the amounts for the accounting records. Records on the deposit slip. Okay. Control of cash payments, pay by check, and limit access to checks. By the way, I had a business and I had somebody steal some checks. Now we locked up our checks in the file cabinet. But as an auditor, I found out 9 times out of 10, the keys to the file cabinet are in the top right-hand desk drawer in that office. So if you want to get something out of the file cabinet, you know where to go. Sometimes, rarely, it's in the center drawer, but usually it's in the right-hand drawer. But you can find the keys pretty quick. It's like taping your password to the top. That is not very secure. That is not a good control. Okay, so be aware, be careful. But someone went in, cleaning crew night, opened the file cabinet, went to the locked check drawer, took out a check from the bottom, wrote some money, ended up doing jail time. They stole. Okay. It was also a family member. Drug issue. They stole money. And there's a long story, but they're straight now. They went into business, they're doing fine. But at the time, they did jail time for a number of issues. So you got to be careful. You got to have controls. And physical controls are good. Lock and key is good, but it's not foolproof. Okay. And even checks have limitations. All right, I'm going to just scroll through some of this other stuff down here. I'm not going to worry about the voucher systems and the petty cash systems, petty cash fund. But I am going to worry about bank services. And let's talk about doing a bank reconciliation. On a bank rec, we're going to go in and share screen. And for a bank reconciliation, we're going to get a bank statement in the mail. Okay, so we got a bank statement. And we're also going to have on our books balance per books. And rarely these match. Because the bank knows some things that you don't as a company, and you know some things the bank doesn't know. So for instance, you wrote checks. But not for cash. Well, outstanding checks. Or maybe you made an error. Transposition. You missed a digit. Instead of $590, you put $950. Or maybe a bank charge, not yet recorded. You bought some checks. Or they have some other charges. By the way, you do the deposit slip, they charge you 2 cents for the slip and a penny for every check that's being deposited. They have to make their money too for processing your stuff on a business account. So what happens on the bank statement? You're going to have to add and deduct things the same way on your books. You're going to have to add and deduct things. So what does that mean? It means you might have outstanding checks that haven't cleared. You recorded them as written, cleared, done deal. But you're going to have to deduct that because you know about it, the bank doesn't. Outstanding checks. You might have a deposit in transit. You recorded the deposit, but the bank hasn't recorded yet. You don't know. Or the bank got a receipt, customer wire, but you don't know about it. You just know the bank knows about it. Or there may be bank charges that have to adjust. But bottom line, you're going to get to a proper balance. So the bank statement balance and the books balance might start here at $2,000. You might start here at $1,200. And bottom line, reality is $1,400. Balance per. Ultimately, these are not adjusting journal entries, by the way. These are adjustments to cash. This is a journal entry to cash. AJEs are not adjustments to cash, but this is an recording of an actual transaction. Bank took some money or found some money. I'm going to go back through and take a look at our reconciliation. We got checks, what they look like, preparing a bank rec. So we have bank balance adjustments and book balance adjustments. We add, subtract things as we go. And this is just a big picture. We've got a cash balance for bank and a cash balance for book. Statement comes in, our books say we got so much, the bank statement says we have so much. We had our deposits in transit, we take out outstanding checks. And then there might be some bank errors. Banks make mistakes. And on our books, we had a cash balance. We got some interest that we got to credit, or they made some collections, so we have to add that. There's maybe NSF, non-sufficient funds. By the way, that's how I remembered Scandinavia, Norway, Sweden, Finland, NSF on the account, what can I say? So Norway's as west as it goes, Sweden's in the middle, Finland's on the eastern border. So NSF, that was the order. So much for geography lessons. But anyways, NSF checks, okay, they bounced. These are money that we thought we had, but the bank said, hey, they didn't clear, got to take that money away from you. And there's also, as a bonus, a charge. By the way, you can always renegotiate those charges. You ever have a bounce check in your account, or you bounce accidentally, you overdraft, they'll charge you 25, 30 bucks. You can go to the bank saying, pretty please, first offense, can you give me the benefit of the doubt? And 9 times out of 10 they will. So that's negotiable. Yeah. Overdraft protection. Yeah, and they charge interest. They love doing that. Yeah, they'll charge either interest or they'll charge a fee to do that. And that's okay. Don't overdraft if you can avoid it. Yeah, but no, but they do that. Whenever a bank asks me, do you want overdraft protection? I say no. Because what happens if somebody's stealing? And all of a sudden, I thought I had $200, and all of a sudden it's negative 2,000. And it's like, well, wait a minute, that's not my money. That's not, you're protecting somebody, but it wasn't me. So that's what I wanted to get to today. Any other questions? Anything else on your mind? So with the hump day, congratulations on reaching this far. I wish you well. I look forward to seeing you in class again soon. Thank you.